Americans give to charity regularly. In fact, they gave a record $427 billion in 2018. But do we place enough emphasis on how we give? Hello, this is Charlie Toole, and I'm a portfolio manager here at Advisor Investments. Welcome to another Advisor You Can Talk To podcast. Today I'm joined by Kari Wolfson.
Hi, Charlie.
Hi, Kari. Kari is an account executive and certified financial planner working with clients here at Advisor. I'm also joined by Rick Winters.
Hey, guys.
Rick is a vice president and certified financial planner, and he's been working with clients at Advisor since 2001. All right, Kari and Rick, all of us work with clients, and that includes advising on charitable giving. Today we're going to discuss 3 benefits of having a charitable plan and the 4 most common strategies of planned charitable giving. You can read more about these benefits and these strategies in our special report, Making the Most of Your Charitable Giving, which is available in the show description. So as I mentioned at the top, there's a lot of money given to charity on an annual basis, but it's likely that people aren't giving much thought to how they give to charity. And Kari, I think a little planning can go a long way.
Yeah, definitely. I mean, it's clear that our clients and people in general feel strongly about giving money to charity. So I think it's less a matter of, whether or not they're giving, but more so, how they're giving. Are they planning ahead? And there are definitely 3 main benefits to planning ahead. It makes it feel a little less transactional. It gives it some more meaning. So let's talk about those benefits. The first benefit is that creating a plan can actually maximize your impact, potentially increasing your giving and reducing your taxes. The second benefit is regarding evaluating charities ahead of time, doing a little bit of research before you decide which charities you're going to give to. Think about any time we make a large purchase. I know last year I purchased a car and I actually put a lot of research into that. It wasn't the most exciting thing to do, but definitely I think paid off in the long run. So do the homework up front.
And number 3, the benefit would be legacy planning. Think about all this effort that you're putting forward on what charities you're going to give to and the plan that you've built on how to give effectively. If you don't think ahead and define whether this is something that you're going to be doing in your lifetime versus the lifetime of your family, because you just never communicated with anybody, is a big decision that you have to make. So one way I'll kind of tie it together, maybe to make a little bit more day-to-day sense, let's replace a charitable giving with running a business. You start a new business and you want it to be successful. You want your clients to be happy. You want to leave the business to your kids so that they can run it after you're gone. However, you've never taken the time to communicate any of this. You didn't build the plan. You didn't have a mission. You didn't have a vision. You didn't pick the specific clients that you wanted to work with, and you never told your kids that you wanted them to run the business later. Sounds like that's going to be a pretty big failure.
Yeah, no, I love the business analogy, Rick. I work with a lot of clients that want their kids involved but don't really know how to get them on the same page. So I think creating a plan and, comparing it to a business absolutely makes sense.
Okay, great. So I think the big takeaway here is that people can really help themselves by creating a plan. And having a plan can help people be more efficient with taxes, more effective with their giving, and can help them plan their legacy in the future. And so this leads into a deeper dive on a few key strategies to improve tax efficiency when giving to charity. And I think this is really important as there's been changes to the tax code, which can really have an impact on what you can and can't deduct in terms of charitable giving. And there's more on this in our special report, which I did mention, that there's a few tables and graphs that can show the impact of some of these giving techniques and what they can do to help you with tax savings.
One of my favorite reads on the weekend, Charlie.
Great visuals, though.
It is great visuals, and it is important because people are just sometimes writing checks and they don't necessarily take advantage of some of the tax savings that they can have. And so I think the 4 strategies that we have: qualified charitable distribution, donor advised funds, foundations, and split interest charitable trusts. We'll go through each one of those, focusing on the different techniques and how they're helping people. So I think our first strategy is going to be the qualified charitable distribution, or the QCD. And Rick, I know this is a topic you're very passionate about, so why don't you get us started?
Yes, actually just had a conversation about it today, meeting with a tax advisor. QCD, qualified charitable distribution. This is something that is available to anyone that is over the age of 70 and a half, and if you have an IRA or an IRA rollover. The strategy is, because what else happens when you're 70 and a half is you have to start taking your required minimum distributions. So one thing that, as you're thinking about your charitable giving, the QCD allows you to actually give money from your IRA directly to a charity that is non-reportable. non-deductible, which means it removes that income from your tax return altogether, and that money counts as part of your required minimum distribution. A couple things that you need to note is that who's thinking about this? Anybody that is over 70 and a half and has an IRA should consider this as an option. You can give up to as much as $100,000. You can give as little as you can write a check for or request a check for out of your IRA. I would say that that's the least you could ask for, is not the efficient way of giving through here. But the reason that you're doing this is because now, more so than ever, with that new tax law that was just passed back in 2017, you are, for most Americans, most are not able to take itemized deductions. And if you're writing checks to charity out of your checking account, well, that's something that you'd have to get over that itemized deduction or the standard deduction amount to be able to take it as a deduction. So if you're not and you're just taking standard, well, you're actually not getting a tax savings. You're not only giving the dollar away, but you're still paying the taxes. So using that QCD would allow you to give that money directly to charity and take that income off the top.
Yeah, and I think, talking about the QCD, not only does it lower your potential, your income for tax purposes, but it also has a huge benefit and potential savings for Medicare.
Yeah, perfect point, Kari. And I can't believe I almost missed that. Is that, if you're 70 and a half, what else do you have? You have Medicaid or Medicare. And every year you have to calculate your income for what's that premium you're going to pay. And if I'm able to take income off, satisfy my charitable giving, because I have this interest, I can reduce my income for that calculation and potentially keep my premiums down. Or if you have medical expenses,
right,
which now the threshold's even higher at 10% for the itemized deductions. Yeah, you lower that income, that threshold's easier to overcome. So there's a lot here. If you're not thinking about it, I'd have to say that in most cases you're missing out. And it's definitely something that you should be having conversations about with your investment advisor right here or your CPA, definitely.
Yeah, and I think it's easier to plan ahead, too, now that it's a permanent law. So we're not rushing at the end of the year like we used to.
Yeah, I know that was always a big issue where waiting until the last minute, the end of December, and trying to identify if that was actually going to be rolled over and be law again. And clients were calling at the last minute saying, hey, I want to make this donation. Now it's permanent. And people can plan ahead, as we talked about at the beginning, having a plan and taking advantage of these things. And so just to quickly summarize the qualified charitable distribution, you can give directly to a charity from your IRA. This does satisfy your required minimum distribution. You must be 70 and a half to take advantage of this. And really the benefit is that it lowers your income, which will lower your taxes and can help also with other things like Medicare as well. And lastly, a $100,000 limit in terms of how much you can give from your IRA. Moving on to our next giving technique, it's a donor advised fund. And Kari, I know this is a technique that can be used by anybody. You don't have to be 70 and a half to use a donor advised fund.
Yeah, donor advised fund, another great strategy. Think of it like a charitable investment account or a personal savings account that you use to give to charity. So breaking it down, a donor creates an account and you can make a contribution of cash, stock, or other assets, even like real estate and artwork, and you can take an immediate tax deduction for the gift. So the accounts are set up with a custodian like Fidelity. We manage accounts through Fidelity for our clients all of the time. And I think the important savings feature to point out is that you can invest the assets until they're gifted to IRS qualified charities. So you don't have to rush and make the decision about what charity you're going to give it to, but you can still take the tax deduction in the year that you want to. They're inexpensive and easy to set up, and really, there aren't many administrative hassles, so they've definitely become popular over the years.
Definitely. And they're very popular for me personally. I know I get to the end of the year and I have a lot of different groups that I want to send money to, but I may not want to give as much as my accountants tell me is a good idea. So I use the donor advised fund as a way to get money in instead of that, mid-December and I'm writing checks to a bunch of charities I wasn't necessarily planning on supporting. I can put it in there and save that for another day. But one thing that kind of couples into some of the things I was talking about under the QCD is that standard deduction comes up again. The standard deduction, just to give a definition, so it's not this mystery thing that's out there, but for a couple over the age of 65, married, filing jointly, has a $27,000 standard deduction this year. That's a mile-high threshold to get over for some folks, especially with the new limitations on the itemized deductions now. So if you're someone in a situation where you do give annually and you do it pretty consistently, what people are doing now is referred to as bunching. It's a strategy that would say, instead of just giving this year's charitable gifts to my donor advised fund or writing them out to charity, maybe what I'll do is I'll pile up 2 or 3 or 4 years. And in that case, maybe we're talking about 10, 15, 50, more, $1,000, but I'm not ready to write them to charity. So I put them in my donor advised fund and get over that standard deduction threshold. Now I'm back to itemizing, and that's just smart tax planning.
Yeah, no, I'm glad you brought that up. I had a few clients panic last year because they only wanted to give a certain amount, and by using the bunching strategy, they were actually still able to itemize. So that is another huge benefit.
Just a little forward thinking there.
Yep.
Yeah, no, and I think another great benefit of these donor advised funds, we get and talk about the legacy aspect. You can set aside a certain amount to your children and allow them to donate to the charities that they want to. So it allows you to start to introduce that legacy component as well.
One of those benefits we mentioned. Yeah, include the family. This is definitely a place you can go long term.
Definitely.
So to quickly summarize the donor advised fund, it's a low-cost way to administer your charitable giving. It allows for bunching of several years of donations at once to maximize your tax savings. And the money can be invested to grow over time as it's dispersed out to charities. And so our next technique is private foundations. Now, a donor advised fund can be called a simple, low-cost foundation. But Rick, when you discuss private foundations with clients, it's a little bit more complicated than a donor advised fund, and it's more than just cost. That's the difference.
Yeah, as in total dollars, private foundations are the most popular in the United States. There's more money in private foundations than in any other way that investors are able to save towards charitable giving. But that doesn't mean they're easy. These are literally run like businesses, and you have that more hands-on interaction tends to include more involvement from those that are overseeing the foundation. The tax filing, there is a required distribution, unlike the DAF, the donor advised fund. There are no required distributions, but you do have a required distribution from a private foundation. Also, there is some tax application to the underlying investments, so it's not completely tax-free. The deductibility of the contributions that are being made is lesser than your other charitable giving options. But if you're someone that is not only interested in giving to charity, you may give to one, you may give to many. The private foundation does provide some flexibility in how that's handled. You can actually be more actively involved in the charities that you're supporting. If you want to go down and fly down to a location to help build a school, and that's part of the foundation's focus, well, those expenses can be wrapped up in the foundation. If you're going to go do that and then write a check through your donor advised fund, none of that can be applied to that check you wrote. The donor advised fund is simply for giving to charitable giving. I have a real life example on both sides. We actually just recently wrapped up a private foundation and moved it over to a donor advised fund because the relationship we were working with was simply writing checks to charity. Every year they had to get their distribution out. They didn't even want to necessarily give the amount they were required to. So we talked about the donor advised fund, and they figured out that actually met their needs more so. Where in another case, where you had a private foundation with a family that is building it over time, and the second generation, and potentially even the third, is already getting heavily involved with the operation of that foundation, there was no chance that donor advised fund was going to be a good solution for them.
Yeah, so it seems like it's all about flexibility. I mean, the private foundation definitely offers more options, so it's really about what you're looking for, it sounds like.
If you did the planning,
yep,
had the mission and the vision,
right,
and then got all that stuff organized early, it makes the private foundation is something that you could consider. The costs are worth it.
And just touching on the costs, because the costs, you want to have more money to put into the foundation. So you're looking at, $1 million or $2 million that you're going to put into the foundation to make the costs worthwhile.
Yeah, establishing a private foundation to put in a meaningful gift, $100,000, is just not going to be right. You have to think, again, you're thinking about long-term. I would even say, you said $1 million, I'd even push it towards $2 million would be where you'd be considering that. I should have said that up front, but thank you for cleaning that up for me, Charlie.
So just to summarize foundations, they are a more flexible option in terms of charitable giving. There's less constraints, but they are more time-consuming and they are more expensive to operate. But they also are a great legacy planning strategy, as it's, like you said, Rick, running a business, and it's time-tested and it's going to go through more generations over time. So our last technique is the most complicated, split interest charitable trusts. Kari, one of the reasons this technique is so complicated is that there are multiple parties that benefit from these trusts.
Right, exactly. Complicated is a good word used to describe them, but I think it is something to consider if you want to give some of your asset to charity and reserve some for yourself or other heirs. So there's two main types, a charitable lead trust and a charitable remainder trust. And basically the difference is when you're collecting the income versus gifting the asset to charity. So with a lead trust, you're gifting the asset to charity up front. And with the remainder trust, you're receiving income throughout the life of the trust, and then the remainder is going to charity. Like all charitable gifts, they are irrevocable, and usually it's not something that you're talking small dollar amounts. You definitely want to discuss with your advisor and your planning team before taking any action. I have, a client that I worked with recently who set up a charitable remainder trust, and it was great for her because she was in her 70s. She owned an energy stock that she really didn't want to own. She's very charitable, and she didn't have any taxable income. So for her, the charitable remainder trust made sense. She was able to get rid of the energy stock, receive income, get a big tax deduction, and ended up leaving the remainder to charity anyway.
What a cool example. I mean, that's like picture perfect.
Right.
There's other examples that I would even use in saying, imagine you had a big event. The business you'd started just got bought out, and you've got, ideally, millions of dollars coming in the door. And at that point, well, not only is your life changing, maybe your situation on what you can consider for charitable giving, but the other reason for thinking about that is because you can save yourself a bunch of taxes. And this is actually one of the more effective strategies, using, split interest remainder trusts or split interest lead trust to be able to take advantage of that. Now, one other thing is that this is something that's very specific to the current tax laws and how you're going to use this in your planning. So if any things were to change on how IRAs are distributed in the future to your beneficiaries, or how you may be able to deduct taxes or your charitable gifts on your taxes, you would always want to be leading in and making sure that you consider one of these two options. And it's something you're definitely discussing with, in this case, Kari, as an expert, and your accountant. Of course, you want to tie those two in. And even because it does involve a lot of estate planning, even your estate attorney. And that three-way meeting with those three professionals is definitely going to be rewarding.
Yeah, definitely.
So Kari and Rick, thank you for the great conversation today. To wrap this up, we suggest that everybody consider how they're giving to charity and evaluate your charitable plan. Most are probably missing out on some form of tax savings if they're just writing checks every year. Some of the strategies we've discussed today may apply depending on your situation, and it is really important to have a conversation with your planning team. Once again, I'll just suggest that you download the special report that we have, Making the Most of Your Charitable Giving. It is available in the show description. And we thank you for listening to another Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe to our show. You can also check us out at www.advisorinvestments.com/podcast. If you have any topics that you'd like us to explore, please send us an email at info@advisorinvestments.com. We'd love to hear your feedback, and we'd love to hear from you. Thank you.